The JPM Europe Equity Premium Income ETF is structured as a sub-fund of the JPMorgan ETFs Ireland ICAV, an Irish collective asset management vehicle authorized by the Central Bank of Ireland. This legal structure is pivotal for institutional investors, as it ensures compliance with the Undertakings for Collective Investment in Transferable Securities (UCITS) directives, providing a robust level of investor protection, liquidity requirements, and asset segregation. The fund is managed by a team led by Hamilton Reiner, the Chief Investment Officer for U.S. Core Equity and Head of U.S. Derivatives at JPMorgan, whose expertise in volatility harvesting is central to the fund's value proposition. While the fund is actively managed, it utilizes the MSCI Europe Index, total return net, as its primary point of reference for performance measurement and universe definition. The fund's primary specifications and trading parameters for its two share classes are as follows: Trexra tickers, JEPE for the distributing class and JEAA for the accumulating class. Total expense ratio, 0.35% per annum for both classes. Base currency, Euro. Income policy. The distributing class pays out monthly, while the accumulating class reinvests gains. Replication and risk. Both classes use physical replication via active selection and carry an SRRI/risk value of 4. The choice of Trexra as a primary listing venue for JEPE reflects the importance of German and broader European liquidity pools for this strategy. Trading parameters on Trexra include designated sponsorship by firms such as BNP Paribas Arbitrage and GHCO Europe, ensuring a minimum quotation volume of €50,000 and controlled bid-ask spreads even during periods of elevated market stress. The active equity component, fundamental alpha generation. Unlike passive covered call ETFs that mechanically track a market capitalization-weighted index, JEPE employs a research-enhanced index, or REI, approach to build its underlying equity portfolio. The objective is to construct a portfolio that exhibits approximately the same beta as the MSCI Europe Index, but with a deliberate tilt toward companies that possess superior fundamental characteristics and lower historical volatility. The fund focuses on developed European markets, including the United Kingdom, Switzerland, and the Eurozone. The investment managers evaluate a universe of approximately 400 to 500 large and mid-cap stocks, utilizing JPMorgan's global team of over 80 equity research analysts. This research-intensive process involves fundamental analysis, estimating future cash flows, earnings growth, and dividend sustainability through management interviews and competitor assessments. Valuation disciplines, identifying undervalued securities while avoiding those whose prices have detached from fundamental reality. Low volatility preference, selecting stocks that tend to experience smaller drawdowns than the broader market, which is crucial for the success of a covered call strategy. The portfolio typically holds between 150 and 400 positions, ensuring that idiosyncratic risk is minimized through diversification. This active layer serves as the Beta 1.0 foundation, providing the necessary equity exposure to participate in market rallies while generating a starting yield from organic dividends. The options overlay, volatility monetization mechanics. The primary differentiator of the JEPE ETF is its systematic options overlay strategy, designed to generate premium income in addition to equity dividends. This is achieved by selling, writing, out-of-the-money OTM call options on major equity indices, such as the MSCI Europe or regionally equivalent benchmarks. The strategy involves selling call options that give the buyer the right to buy the index at a predetermined strike price. In exchange for this right, the fund receives an immediate cash premium. Strike placement. The options are typically sold out of the money, meaning the strike price is higher than the current market price. This allows the fund to capture some capital appreciation of the underlying stocks before the option caps the gain. Duration and laddering. The fund utilizes short-term call options, often one-month expirations, and staggers them across weekly buckets. This laddering approach diversifies the strike prices and expiration dates, reducing the risk of a single market move significantly impacting the entire options portfolio. Index-level focus. By writing options on an index rather than on individual stocks, the fund captures broad market volatility and avoids the higher idiosyncratic risk associated with single-stock earnings events or corporate actions. The expected income from these premiums, combined with the underlying dividend yield, targets an annualized distribution of approximately 7% to 10%. This yield is mathematically linked to the implied volatility of the European market,
In periods of high uncertainty, call premiums rise, potentially increasing the fund's distributable income.
Performance analysis in varying market regimes. The JEPE ETF is designed as a weather-resistant income solution, but its performance is highly sensitive to the specific trajectory of market movements. Institutional investors must evaluate the fund across three primary economic scenarios: sideways or range-bound markets. In an environment where European equities trade within a narrow band, e.g. plus or minus 5% annually, JEPE is expected to be a top performer. The fundamental portfolio generates dividends, and the call options expire worthless, allowing the fund to keep the full premium income. In 2026, with the outlook for corporate profits healthy but valuations elevated, a sideways market is a highly plausible scenario where JEPE's total return could exceed that of a passive index. Significant bull markets. In periods of rapid equity appreciation, the covered call strategy faces its greatest challenge. While the underlying equity portfolio rises, the gains above the strike price are effectively forfeited. This upside truncation means that JEPE will likely lag the MSCI Europe Index during sustained rallies. Investors pay for the high monthly income by sacrificing the potential for large capital gains. Bear markets and sharp drawdowns. During a market meltdown, JEPE provides a degree of downside protection, but is not a risk-free asset. The premium income acts as a partial hedge. If the market falls by 10% and the fund has collected 7% in premiums, the net loss to the investor is reduced to approximately 3%. However, the underlying equity portfolio still carries significant market beta, and in a crash, the NAV will decline. The fund's SRRI of 4 on a scale of 1 to 7 accurately reflects this moderate to high risk profile.
Risk analysis beyond the headline yield. Investing in the JPM Europe Equity Premium requires a nuanced understanding of risk factors that are often overlooked in simplified marketing materials. These risks are structural, operational, and market-based. 1. NAV erosion and capital depletion. One of the most critical warnings found in the fund's prospectus concerns the source of distributions. The directors may declare dividends out of the sub-fund's capital. If the total return generated by the equity dividends and option premiums is lower than the target payout, the fund must dip into its capital base to maintain the distribution. This process of capital erosion reduces the NAV, which in turn reduces the fund's future capacity to generate income, potentially leading to a long-term downward trend in share price. 2. Upside participation risk. By systematically selling call options, the fund is short volatility. In a year like 2026, where fiscal stimulus and technological breakthroughs could drive unexpected market surges, JEPE investors face the risk of regret as they watch the broader market outpace their income-focused vehicle. This is not a buy-and-hold investment for those seeking maximum terminal wealth over a 20-year horizon. 3. Volatility compression risk. The level of premium income is directly proportional to the market's expectation of future volatility. If European markets enter a period of prolonged calm, historically referred to as volatility suppression, the premiums available to the fund will shrink. This could lead to reduced distribution, a drop in the monthly payout to investors, aggressive strike placement. The manager may be forced to sell calls closer to the current market price, at the money, to maintain the yield, which further increases the risk of upside truncation.
4. Strategy risk. The gap up and V-shaped recovery. Covered call strategies struggle with path dependency. If the market gaps up significantly, e.g. opening 3% higher due to a weekend geopolitical resolution, the fund incurs a loss on the options position that may exceed the gain on the underlying stocks for that period. Similarly, in a V-shaped recovery following a crash, the fund participates in the full downside, but its recovery is limited by the sold calls, making it difficult for the NAV to ever return to its pre-crash highs. 5. Counterparty and synthetic risk. While JEPE is a physically backed ETF, it uses derivatives to implement the call overlay. In some jurisdictions, these strategies use equity-linked notes, which introduce counterparty risk to the issuing bank. For the UCITS version of JEPE, the focus is on equity call options and/or equity index call options, which may be exchange-traded or OTC. While JPMorgan monitors counterparty risk rigorously, any failure of a derivative counterparty could lead to tracking error or financial loss for the fund. Comparative analysis. A key insight for the European investor is the structural income advantage of the European market. The MSCI Europe Index currently yields approximately 3.03%, compared to roughly 1.62% for the MSCI World Index. This means that JEPE begins with a higher organic yield base than its US or global counterparts, potentially requiring less aggressive option writing to hit its 7 to 10% target. This could lead to better NAV preservation over time compared to the more premium-heavy US versions.
Comparison with external competitors. JEPE competes with other active and passive income ETFs in the European market. Global X Europe Covered Call ETFs. These are typically passive and may sell options at the money, offering higher headline yields, 10 to 12%, but with significantly more NAV decay and less professional oversight on the equity selection. Fidelity and iShares Dividend Growth ETFs. Funds like FUSD or QDVX focus on dividend growers rather than options income. These offer lower yields, 2 to 4%, but preserve the full upside potential of the stocks, making them more suitable for long-term capital growth. Tax considerations and operational details for European investors. For investors utilizing the Xetra-listed JEPE ticker, the tax treatment of monthly distributions is a paramount concern. Monthly distribution schedule. JEPE is designed for cash flow-focused investors. Unlike most European UCITS ETFs that distribute quarterly or annually, JEPE pays out every month. This mimics the experience of a monthly salary from the investment portfolio, making it highly attractive for retirees or those living off dividends. Tax efficiency across jurisdictions. Irish domicile. Ireland does not impose withholding tax on distributions to non-Irish resident investors in UCITS funds. Local tax treatment. In Germany, the JEPE distributions are generally subject to the Abgeltungssteuer, 25% plus solidarity surcharge. Investors should check if Teilfreistellung, partial tax exemption, applies based on the fund's equity quota, typically 30% for equity funds. Accumulating alternative, GEEA. For investors in high tax brackets, the accumulating version GEEA may be more efficient, as the gains are reinvested within the fund's NAV, delaying tax liability until the shares are sold.
Conclusion. The JPM Europe Equity Premium is an instrument that effectively bridges the gap between traditional equity investing and alternative income generation. By leveraging an active, research-enhanced equity portfolio and a disciplined laddered call option strategy, it offers a compelling solution for the income investor. Key takeaways for investors. High yield with lower volatility. The fund successfully targets a 7 to 10% yield while maintaining a defensive, low-volatility equity tilt that typically results in a lower beta than the MSCI Europe Index. Structural advantage in Europe. The naturally higher dividend yield of European stocks provides a more stable foundation for the fund's distributions compared to its US-based counterparts. Active management versus passive mechanics. The ability of Hamilton Reiner's team to dynamically manage the options overlay and selectively pick stocks provides a critical alpha layer that passive covered call ETFs lack. Defined risk profile. Investors must accept the explicit trade-off of capped upside in bull markets and the potential for NAV erosion if the distribution targets are too aggressive for the prevailing market regime. JEPE is most effectively utilized as a core income anchor within the European equity portion of a portfolio. It is ideally suited for investors who prioritize current cash flow and downside mitigation over aggressive capital appreciation.